Hey, welcome to the show, Total Financial Solutions, Safer Money Hour. Arif Halaby and Jeff Gerard on your place for news, talk, and information, talking about your family's finances and, of course, managing your retirement assets. Look, if you've seen our billboard out on Railroad, it's very simple, very plain. And what does it say? It says, new rule, slow and steady wins the retirement race. Now, why do we say that? Because if you've seen today, the market is dropped again. It's incredible, the changes that are happening in the economy. I love it when they say things like, oh, it's a correction in the market.
What does that even mean?
So that means something had to be wrong, which was if your account went up, that's wrong? I love the terms that Wall Street uses because for you and I, as everyday savers, trying to put money aside, trying to make sure some of it is there, all of it is there for retirement, we look to see how can we build something that is a bit more of a sure thing. Our pensions used to be that. You know that? Our pensions were the sure thing. Saving for your retirement in your retirement accounts, your 401ks and 403bs, that used to be a sure thing. Today, with accounts dropping thousands and thousands of dollars, in some cases in a day, that's a little scary. So I want to bring up something that has really come a long way in the last 30 years or so, and they're called fixed indexed annuities, fixed indexed accounts. It's basically something we specialize in, and so I want to address it from the point of view not just as an actual, insurance professional in that world, but also as a client, somebody who has similar hopes and fears and dreams and same things that you might actually have, I guess, in your life. So let's talk about some of the advantages, if you will, and the benefits, and the drawbacks, too, because there are a few, of a fixed indexed annuity.
Arif, I want to bring up something very important because you said something key. You have some of the same concerns, and as a financial person, you can have any financial product in the world. So just because you're on this side of the table, so to speak, doesn't, and you may have some insight that the everyday worker or saver does not have or may not have without extensive research. I mean, let's face it, you've been in the business nearly 20 years. So you should have some type of insight, and I can attest to that because you've taught me quite a bit of it, and I appreciate that. But those fears don't go away with more knowledge. Just because we know how and things work, that fear doesn't get removed with that knowledge. And now what we are privy to is some of the things that can hedge against that and actually help protect us so that we don't have to constantly have this nail-biting scenario and wondering, gosh, how far down is the market going to go or correct or whatever word they want to use. At the end of the day, someone lost money. And how do we change that? And it's really based around having some balance. And I think a fixed index annuity has a place in just about everybody's retirement that has some money they want to count on.
And think of it like this. The word annuity is a bad word, at least to a lot of people.
Right.
Because the old ways that they were done, you would collect a payment, one payment, and if you passed away, because you collected a payment, you forego the right to have access to the rest of those funds. Those are not the way that they operate today, at least not the ones that we work with. You have options where you can have these accounts and put money in, take it out, put it in, take it out, do whatever you want with it, subject to a few different rules depending on your age and depending on the type of account, etc. But overall, there are 3 different types of annuities. So let's clarify that. One of them is called a fixed annuity. It acts very similar to a CD, meaning there's a time commitment, a year, 2 years, 5 years. Today it's usually somewhere in the neighborhood of 5 years or so based on interest rates.
Yep.
And they pay you a flat interest. That interest you earn every year. If the market goes up or down, it's irrelevant. You're earning 3%, 2%, 5%, whatever that number is, it's coming into your account. So your rate of return and the growth of your account is basically a straight line at an angle. There's no ups or downs, no funny business, nothing. So what are the pros with that? Safety. You're not going to lose any principal. You have an agreement with the insurance company, so you're going to want to work with usually A-rated insurance companies that have been around for a while. And at the same time that have good numbers. In other words, good customer service, good rates of return, minimum guarantees, things like that.
Renewal rates are important as well.
That means that a year from now or 2 years from now, those rates are still high, even though they have your money. They don't have to make it high, but they do. And those are important. Track record is key. Second is, we'll go to the other extreme, which is called a variable annuity. Now, you're still investing in the market, usually in mutual funds. That means your money is in the market. They take an insurance company and wrap it around it. So here's the pros to that. There are some minimum guarantees. That means that if you're going to go for income and the formula works to your benefit, you may be able to take the money out 10, 15, or 20 years from now and have a minimum guarantee of income regardless of what's happening to the market. The cons to that, you're paying a fee for that, a significant fee, sometimes as high as 5% or more every year on the balance, period. I think Wharton School of Business did a study, and I want to say the average fee, I think it was 2.35%. And that is still a lot of money, folks.
It is. And you have to remember, this is fees, plural, because multiple layers are being built into this product so that it can work a particular way. Now look, at the end of the day, someone didn't create this to hurt somebody or to fee it to death, but by nature, you have a lot of pressure on the money that you put into these types of programs, and it has to fit a very specific part of your life. And Arif, I love that you've said that, every product, just about every product, has a place in someone's life out there, and that's why it was created as such. However, people forget that there are other layers that you might have to build in before you make that a part of your financial portfolio or your financial life, whatever have you. It doesn't mean that just because there's someone shouting at the mountaintop, this is the greatest product since sliced bread, that everybody should run to it. By no means is that the case. And that holds true with many products and many different places you can put your money out there. Everybody thinks, when real estate's going up, everybody should rush in there. And when stocks are going up, rush in. Really, that's your barometer because everybody else is making money there. That's a good thing for you. I think you should be really cautious when you see that. And certainly, I have to say it, variable annuities are part of that wave where it depends on who's promoting them, and they kind of make it fit just about everybody that they come across.
Here's one of the things to watch out for in a variable annuity. Make sure it matches your needs. It's one of the top annuities out there. You have to deal with a securities licensed professional, somebody who is licensed to sell these, to explain these to you, etc. But there is risk. One of the downsides are if the market goes down, you could lose some of your principal and any interest that you gain. In fact, you could go backwards very easily of what you put in. You went to work, you worked overtime, you made some money, you did something, you put those dollars into an account and off it went, and now what? They fee those dollars even though it's less than what you had in when you started the account. So be very careful. Make sure it fits for your needs. And the truth is it always fits for the advisor's needs, but it doesn't always fit for yours.
And some of the advantages there, really, if you like being married to an account for the rest of your life, put it in a place where it could go down. And in order for you to get your money back, which they say, hey, look, these accounts have some type of income, as Arif pointed out, there's an income component to it. And we have seen that it takes about 14 and a half years from the time you say, okay, give me all my money back, even though I'm in a loss scenario. It takes a very long time to get that money back. So if there's a particular account you don't like, or you're not really fond of it, imagine being married to that for the next, however many years it takes for you to be made whole again. And that's why the insurance component is part of that conversation. It's because it's trying to help you, protect against that type of loss. But at the end of the day, you still have that risk that you're holding, and you're paying fees on top of that. So be careful with that type of thing. But there's a hybrid in between, is there not?
Yeah, there is, and it's often called as a hybrid. In fact, that's more of a marketing term done by one particular individual who is very big in the sales of indexed annuities. It's kind of his thing. So he coined the phrase hybrid. It's more of a capitalization on the term hybrid being used for automobiles that are half gas, half electric.
Right.
So it really took that term and took it to the level that everybody wants to feel cool, so they got a hybrid. So here's what it does. It is called a fixed indexed annuity. You might know it as an equity indexed annuity. Where is its place? Its place is in a portfolio or in a retirement accounts that says we've already saved up a lot of our money. We don't want to lose it. We can't afford to go backwards and lose another $80,000 like we did in the last crash, or the last two crashes, or the last three crashes.
Yeah.
We have saved up some money. We want to preserve half of it, or 3/4 of it, or whatever percentage that is in that particular retirement account. You want to set it aside, not have it go backwards if the market goes backwards, and not be subject to market declines. That is the first checkbox that says maybe this is the right place for it. The second is to say, and there are some good ones out there and bad, just like in all three of these that we're talking about, is to say, I don't want to pay any fees. Goodness, does that even exist? Can you put money into an account and not pay a fee? Yes, but there's got to be a catch. Well, in fact, there are two catches. Simply put, catch number one, there's a maximum gain you can earn. In a variable annuity, the only thing that restricts your upside are the fees, meaning if there's a 30% return in your account and there's a 3% fee, well, you still collect 27%, generally speaking. Got the idea?
Yeah.
In a fixed indexed annuity, you receive a minimum guarantee, if you will, of usually 1%, but your rate of return every year will be between 0 and whatever the cap is. So if the cap is 10%, it's going to be 10. If it's 12, it's 12. If it's 15, you get the idea. So let's say your cap is 12%. That means your rate of return is going to be somewhere every year between 0 and 12. What is the average? Well, the average is probably going to be between 3 to 6% per year. Sometimes a little more, sometimes a little less. But never will you lose interest or that you've been paid or the money that you've put in. If the market goes backwards, if it's a bad day, you never get a zero in that account. You never get a negative in that account. You just would receive a zero. And why do I share that with you? Because look, there are some fixed index annuities that have huge fees. I think you should avoid those. There's no reason to have them. There's other accounts out there.
Because the fees don't give it really that much more benefit, because these as a baseline account, the individual annuity itself has some specific features that can cover income, they can cover guarantees, they can cover keeping up with inflation, and some people get gimmicked or tricked into thinking that some of these accounts, because remember what Arif said, some of these are good, some of these are great, some of these are not so great, and part of that is some of those little things that they hide, whether it's fee-wise or they put a feature on there that is touted as something that's going to change the account drastically, but at the end of the day, you're going to end up paying a fee, and you might not even use that feature. So that's where the research comes in and working with a professional that knows this market very well so they can kind of guide you in the right direction.
And one of the things to think about is what has been the average rate of return over any period of time. So let's take a 5-year window. So just a rolling 5 years, starting in 1997 and going until 2009. So every year that passes, you pick up a new year and give up the old. So a rolling 5-year return is somewhere between 4% and 9%. That means that in any 5-year period, your average return per year is somewhere between 4 and 9. Now that's important to know because in a 5-year rolling period of time, you're looking, I don't want to get too technical here, but you're looking at, if I'm going to retire in the next 5 or 6 years, can I afford to still keep my money in the market? Now some of you are asking yourself, is it time to make some changes? Well, maybe. You can always give us a call. It's 753-9683. I don't know if we can help you. You have to kind of qualify for it, meaning, it has to fit your needs. It has to be suitable. If it is, great, we can help. If not, that's okay. We'll let you know. The idea is to say, should I have some part or all of my money in a safe place protected from market declines? I've already saved it. I've already paid taxes on some of it. Maybe you didn't pay taxes on it, but you've already expended the effort and you've earned the money. You can't go back and get that hour or 10 hours that you worked overtime 4 years ago and those dollars you saved. You can't go back and get that time back. And so you exchange that time for money. Now they paid you money. You have that money in your retirement account. Now Wall Street seems to think that they can continue to fee that same dollar. That's what blows me away. The dollar's already been feed once. Why are we feeing it again? And then again and again. And then you lost my money and you still fee me again. I understand the whole process because, it's what we used to do. It was a long time ago. It was part of our practice. But I had to come to grips with the fact that we just lost your money. We charged you a fee. And I couldn't understand why Wall Street thought that was okay. Like, what are we buying? Right? Because when you pay a fee, you're buying something. What are you buying? I don't know. So be very careful when you're out there and your retirement accounts are at risk. If you want some part or all of your money in a safe place, great. If you don't, that's okay too. Some people want the risk. Some people enjoy the rates of return, which could be huge. And a fixed indexed annuity is designed for that middle of the road, for some of those dollars to be set aside. You might say, the potential of higher rates of return, I'm willing to take that risk, no problem. When we come back, we're going to get into some advantages of Roth IRAs and why you might want to consider having a Roth IRA. And should you have, and here was the layer one excuse conversation they taught us when we talked about annuities, and here it was. Why would you take a tax-deferred account, which is your retirement account, and put it in a tax-deferred account, which is an annuity? Because I'm not buying it for tax deferral. I'm buying an indexed annuity or a fixed annuity for the rate of return, for the methods that it uses to build and create and protect my principal, and for the way that it's calculated in the underlying savings/investment. That's why I might be buying an indexed annuity. So it's not, so who cares if it's an IRA, Roth IRA, traditional, it doesn't matter. I'm not buying it for the tax deferral. I'm buying it for the underlying method of calculating interest. When we come back, we'll get into that and a whole lot more. Roth IRAs, what are some of the advantages, and should you have one? And how does it work if it's wrapped inside of an annuity? What does that mean? There's some good ones and bad ones. We've got that and a whole lot more. Arif Halaby along with Jeff Gerard on your place for News Talk and Information. Total Financial Solutions Safer Money Hour on AM 1220 KHTS.